This webinar analyzes balance sheet items in terms of differences among prepaid expenses, deferred charges, deferred revenue, and amortization of capital assets. Prepaid expenses. They are recorded as an asset on the balance sheet. Why? Because these expenses are prospective benefits with either known, as in the case of advanced rent, or unknown returns, as in the case of an insurance policy. The latter example is that of prepaid insurance. In case of insurance, the monthly expense is allocated on the earning statement until the asset is completely retired. Deferred charges. They are type of prepaid expenses also recorded as an asset on the balance sheet. The subtle difference is that the deferred charges are spread over a longer period of time. Another parallel example of writing of deferred charges is amortization of capital assets. Deferred revenue is somewhat opposite of deferred charges. You receive money in advance for goods and services which will be delivered in future. This unearned revenue is a liability to be disposed of at some stage. Amortization refers to allocation of the cost of capital assets, net of their salvage value over their useful lives. Annual allowances for amortization appear as non cash charges against earnings in the earnings statement. The process by which recording of lump sum expenditures as an asset rather than as an expense is called as capitalizing. The asset is then amortized net of salvage value until it is completely retired. Because the annual allowances for amortization appear as non cash charges, it is understandable that the cash flow from operations can differ from earnings depending upon the magnitude of amortization allowance.